All right. Good evening, everyone. I hope everyone's having a great day. And this week has been relatively brief, but I hope it continues to be good for you. So, just wanted to kick off the call this evening. Again, wanted to run through some strategies that I think would be very helpful, especially with this market going sideways. And I alluded a little bit to it just through my various postings, but we're going to be going over what's called covered calls and the idea that you can make money in any market. And covered calls is definitely a strategy that you can use. So, wanted to absolutely make the most efficient use of your time, and I'm going to try to keep everything to about a half hour. And then that way I can take some questions afterwards. And I'll definitely have a video of this right after to be able to be posted. So if anyone was not able to join us tonight, definitely wanted to make sure it was available for you, and you can go back and listen to it whenever you want. So before we really get into the strategy, wanted to just touch base a little bit around who I actually am and why should I even be teaching this stuff, right? Because I'm sure you've probably seen ad nauseum the amount of information there is out there around trading and all the experts and everyone that can help you trade. Well, let me tell you a little bit about myself. So again, I'm Corey Schrader. I do have my chartered financial analyst and certified financial planning designations. Both of them are fiduciary designations. The CFA is actually dedicated towards portfolio management and spending a lot of time around just economics, how to build an investment portfolio, how to manage risk, whereas the CFP is more related to financial planning, estate planning, income planning, both of which I've been able to use for over the last 15 years. I've also created my own firm, as you should know, just by joining me today, Black Creek Wealth Management. I started it about a year ago. My 1 year anniversary will actually be in a couple weeks, so super excited about that, and there'll be more on that to come on how we're going to celebrate. But prior to actually joining the firm, I spent a long time with Fidelity and their investment management group. Outside of that, then I worked for a financial planning firm, TD Ameritrade, worked for them for a little while, did some actual planning there. And then shortly after, I went to a small firm here in Jacksonville where I was responsible for managing over $250 million and also doing financial planning for clients. So getting to utilize, again, both sides of my designation. So as you'll get, I hope, through the theme of what I'm going to do here today, is I really enjoy helping people, especially getting to their goals as quickly and safely as possible. I've been extremely fortunate and blessed to be able to use the knowledge that I've amassed over the last 15 years. And of course, through my designations, being able to apply a lot of that to help me achieve my goals as quickly as I could. So I have a lot of give back that I want to be able to do. And I love being able to help people visualize and get things that they didn't think they were going to much sooner than they thought they would, especially using retirement as an example. I love when I can help people retire a couple years earlier. It's something that I love to do. So overall, that's who I am. That's what I've done. I've done investment management as far as asset allocation. Been doing that a very long time. That's your normal run-of-the-mill investment portfolios that you've probably seen at your TD Ameritrades, your Fidelities, just your basic investment management. But where I really, and what I've actually introduced into my firm is the alternative strategies, meaning covered calls, which I'm going to go over today, various spread strategies, and a couple other things that I plan on releasing later this year that I think you'll really take advantage of and that you really like, that can just complement, again, the traditional types of investments. So super excited to be going over cover calls today because, again, I think it's extremely applicable to what's going on in the market. So let's talk a little bit about why we're even here, and that's how do I make money regardless of the stock market movement? Well, again, covered calls. That's why we're going to be talking about it today. So the whole idea of making money in and of itself is to try to achieve your goals, again, as quickly and safely as possible. Well, when you see the market, I'll use the S&P 500 as an example. You've probably seen it over the last 2 weeks where it goes up, it goes down, it goes sideways. here recently has been going down a lot more than it's been going up. And that's because, as I'll be able to show you here in a couple minutes, the market is actually in what's called a sideways to downward trend. And it's directly a result of the idea of raising interest rates, which is a negative when it comes to growth, and stocks in and of themselves are designed for growth. And also we happen to have Russia going on right now. So wouldn't it be nice to be able to still be in the market? Bogle, your Vanguard, most people that are familiar with indexing, which is just buying an index and letting it run, you go up and down with the market. Doesn't matter what happens. Regardless, you put your money into it 10 years later, hopefully it's higher than what it was when you put it in when you started. Well, covered calls, and as I'll go into it here in a second, is a way that you can actually take advantage of these movements throughout time to be able to enhance those returns over time without necessarily taking on a dramatic amount of risk. So what we're going to talk about today and what we're going to run through is what is a covered call strategy? How does it even work? Once I understand what it is, can I do it on everything? And if so, what is the best timing that I should be looking at so that way I don't get in trouble? Or what is the flip side of that? When can I do it so I can really take advantage of it? And then what are the resources out there that can help me with the actual strategy? Okay, pretty straightforward. Like I said, I want to make the best use of our time, and I'm not here to hold your ransom. I just want to help you all make some money and make it quickly, but also make sure that you understand how to actually do it. So when we talk about what a covered call actually is, I'm a visual kind of person. I worked in the restaurants, just the way my mind just thinks. Try to keep it as simple as possible. So what is a covered call? Well, I'm going to get into what the calls actually mean. But before we do that, I want you to think of it this way. And most people have a house, or if they don't have a house that they've bought, they're renting, right? Well, think of the real estate market for 1 second. And here's how we're going to relate it. Let's say you have a rental property, okay? Let's say here in Jacksonville, you've been able to follow whatever you just in your mind, you say, I need more income so I can do some extras, take some trips, travels, buy some toys, whatever it may be. So I have a rental that I purchased. I bought it, 5-10 years ago. And I've been lucky enough to put it into a community or buy it in a community that is around a school or something that I know I can rent it and get pretty good rental income. Here in Jacksonville, you could probably buy a $250,000 house, and I'll use Orange Park as an example. You could probably rent it for about $1,500 a month, 3-bedroom, 2-bath, right? Not a bad strategy. In some cases, I do recommend it if you do have the ability to do it. But here's how a covered call relates to real estate, but also relates to the stock market. Most of us have in our 401ks, or if we have additional investment money, we have bought, or we've been taught to buy, the S&P 500. So SPY, VOO, these are just the top 500 companies in the United States. You buy the index. If it goes up, it goes down. Who cares? You bought it today. You're going to hold it until you need it for retirement. Well, think of the S&P or SPY, VOO as a rental house. You're not going to sell that house next week. You're not going to sell it next month. In fact, you've bought that rental house for rental income to be able to hopefully use that over time to be able to buy another house and to buy another house, if that's your strategy, to be able to get rental income with never having to sell that house. Well, good news is a covered call is similar to rental income on your stocks. Okay? Think of it. Buy the S&P 500, and I'm going to show you here in a second what an actual call is. But you buy the S&P 500, well, what if you could rent it out and get rental income, meanwhile never selling that house? Your return on investment is going to be way higher than people who are not doing this type of strategy. And also with it, there's some benefits that comes to actually having this type of strategy. So again, I've used a little bit of jargon here, so let me back up and let's talk about what is a call, what does it actually mean? I mean, it's not like I'm calling my friend, right? I mean, that's kind of cheesy, I know. But what does it actually mean? So if you look at the chart here, and I put in here specifically, this is what's called an option chain. So a call is an option. And just as it sounds, an option gives you an option to do something. Okay. Now, I'm not going to go into all the various things. I'm going to keep it extremely simple. There is something called a call. Okay. An option, a call option, gives you the right to purchase something at a specific price. Okay. So I want to buy a car. Let's say my favorite car, and I'm dating myself here, but I really love the Mitsubishi 3000 GT. Like if you're from the 90s, that was the car, right? Well, nowadays, let's just say it's a Ferrari or whatever, or a Corvette, or hell, a Tesla, right? What if you could say, Tesla, I want you to sell me the option to buy a Tesla car, whatever one, at $40,000. Okay, but I don't want to buy it right now. I want to buy it in like 6 months. Okay, but I'm going to buy it for $40,000. Okay, Tesla agrees to this. I'm going to pay them the premium or the cost to be able to have the right to purchase this car 6 months from now at $40,000. Well, let's fast forward 6 months from now. Okay, now the car is worth $45,000. But Tesla told me I could buy it for 40. That's awesome news because now I can buy it at a cheaper price than what Tesla's selling for right now. Think of it with the pandemic. Imagine if you could have bought a used car for way under what the used car prices are right now. Okay, so I paid a little bit today for the option to purchase it in the future. Well, let's say the price of the Tesla went down to $35,000 and I told them I would buy it for 40. Well, good news is I may have paid a little bit out of pocket for that option to buy that, but now that the price is lower, I don't have to keep that deal with Tesla. So yeah, I paid that little bit of premium up front. It's a sunk cost, but I can probably go out into the market and actually still buy the car cheaper than had I exercised that option with Tesla at 40,000. So even though I was able to pay a price up front, it was a small price for the option to buy something in the future. If the price is higher, I've made out. If the price is lower, I just walk away. And that's the beautiful thing about what an option allows. It gives you the right to purchase something, but not the obligation. So I can do it. I don't have to, but I can. So what a call option does is it allows you to buy something at a preset price that you've done today, that in the future you have the option to walk away or to purchase it. And ultimately, when you get into this options type of strategy, and a lot of people aren't familiar with this is because this is a little bit more down the road than your traditional buying a bond and selling a stock or buying a CD. What this allows you to do is this allows you to make money as if you were Tesla. So let's look at that. Okay. So up on the top here is a chart of the S&P 500, and below is an option chain of these call options that I'm talking about. Okay. So how does it actually work? Well, if you can look at the chart at the top, this is the S&P 500. Let's say you purchased your stock right around $410. You bought the S&P 500 at 410. Okay. Let's ride this wave, ride this wave. Okay, now let's look at this week, okay, where this stock is at. Let's say you didn't buy it back at 410. Let's say you bought it at 437, which is what it was this yesterday. So you bought it at 437. So now you say, you know what? I'm not going to sell it anytime soon. I think it's, the right time to get into the stock market. and I'm going to buy this today and hold it for the next 10 years. Okay. Well, as opposed to buying that option, we're going to act like Tesla and actually sell that option. Okay. So we're going to sell somebody else the option to buy my stocks or buy my car at a predetermined price by the end of this week. So what this chain down here does, and all this does is list the varying prices of, in dollar increments of where the price could be by the end of the week. So what we're looking at here is we're using a little bit of price forecasting to say, where do I think the price will be by the end of this week? And I'm going to have an agreement with somebody else that they have the right to buy my shares at the end of the week if the price hits the price we negotiate. So remember, I used 40,000 with Tesla. Well, when we look at this, I'm using various indicators and different things you can see with the market to be able to gauge, okay, over the next week, where do I think the price will be? Well, let's say I'm going to use this number up here, $450, okay? Well, on the left side here, it says 81 cents, okay? Well, each one of these contracts is what they're called, is 100 shares. So if I had 100 shares of S&P 500 or SPY, I could sell somebody a contract to buy my shares at $450 by this Friday. And for that option, they would pay me 81 cents for that contract. Now, the thing to know about these contracts is it's actually 81 cents times 100 shares. Okay. So you're actually looking at about $81 for this actual transaction. Okay. So, and you may say, hey, $81 is really nothing, right? Well, if you look at it, I'm going to get into this here in a second. $81 on an investment, let's just say $437 times 100 shares is $43,000. That's still $80 a week on 43,000, which is almost 0.25% a week. Okay. So if we look at it and we say, okay, that's not too bad, right? If we look at that and you look at it on an annual basis, okay, you're basically bringing in, let's just use 0.25%, you're bringing in almost 1% a month. 1% times 12, you're averaging an extra 12% potentially over time. So this strategy allows you to look at what is going on in the market. And I'm using a week because I personally prefer to use weeks because it's a much shorter time frame. But you can do it weekly, bi-weekly, monthly, quarterly, annually, many different things. So I know I just threw a lot out there, but let me back up and let's look at a scenario for a second. And this is a little bit about what I just talked about. So let me actually draw it out here. So if we buy 100 shares of the S&P 500 at $437, that's an investment of $43,700, okay? If we look at what I was just telling you, there looks like a little bit of some resistance, which means the price has basically gone up to it and just it hasn't broke through, as you can see by a couple of times where it's touched this line, okay? And again, I'm looking at it from, will it hit it by Friday? So if you look at 452 by the price, it would have to move 3% in the week for it to even touch that level. On average, the S&P 500 averages about 2, maybe 3% a week, okay? But another thing that's going against where the price may go by the end of the week is it's actually what's called a downward trend. It's been going sideways ever since these interest rates have been going up, ever since, this concept of Russia invading. So there's a couple of things that are keeping the price from basically going up, and it's hitting the ceiling, or called a resistance. So if I look at this, and again, every week is not static, right? It's going to keep moving, and we move the bogey and prices with it. But each week you look at it and you say, okay, well, where do I think this price will be by the end of the week or quarter or year? And then I look at the options chain to say, okay, where do I think I can sell my option to basically make this premium for this week? And if you look at the 452s, which are right here, you can sell at 52 cents or $52 on, again, $43,000. So the idea here is to be able to keep going and going and going and going every single week and make this rental income, or quarterly or monthly or higher, whatever the cadence is that you want to run this, because the more time you have, you can actually capture a little bit more premium or a little more income. And there's a trade-off, and I can get into that and go into that with you. But overall, the concept is you're not going to sell the house, so you might as well go ahead and rent it and be able to make that extra income, right? So it makes sense, right? Why not? This is a perfect strategy, right? Okay. So maybe we should take a timeout and look at this for a second, because I've basically said to you, it's all sunshines and rainbows, right? Like, okay, we can buy something, we can sell something against it and make money every single week, and we're going to make a lot of money, right? That's basically what I'm saying. And oh, by the way, you need at least 43,000 to get started. Let's back up. I'm not in the mindset of trying to tell you that it's that simple, because it's really not. There is some things that we got to look at. And there are some good news and bad news that we need to run over with this, just so you have a firm understanding of what this actually is. And this plays into what I was talking about with, you can make money in any market with this strategy. And here's why. So let's talk about no more sunshines and rainbows. Let's talk about the bad news first, okay? You buy the S&P 500, you're still selling insurance against your actual position, right? You're not going to be able to prevent that underlying position from losing value. We're not doing anything to protect the downside. We're just saying that if we're just going to ride the roller coaster, we might as well sell some popcorn while we're on it, okay? If the price goes higher, like I said, if it hits that ceiling at 452, well, what happens if it's at 455 by the end of Friday? Well, you lose that extra $3 on that position. You get to keep the premium, but you lose your shares, and you lose that $3 gain from 452 to 455. So that's where, again, we're shooting for a price bogey by that certain time period that we've looked at, that we've put into the strategy. And let's say you need to close out the position, or you want to close out the position. Well, what if you needed to get access to that money? Well, you can't sell the underlying shares until you close out that option position, because that option is actually using your shares as collateral. So you can't say, hey, I need 20,000 out of that 40,000. Let's go ahead and sell it and keep the option. You got to sell the option first, and then you can get access to it. Now, it's not anything you can't do. It's just, again, it's a limitation of the strategy. So the negative aspect here is there's no downside protection. If it goes past your strike, that 452, the ceiling, the resistance, you might lose any upside appreciation in that short term. And then again, if you need that money, you got to close out the option to be able to release the collateral to get access to it. Now, here's the good news. And this is, again, how I look at it. You receive the premium cash right away. So you put in the trade on Monday, by middle to end of the day, that money is in your account. So I'm only talking about doing this on 100 shares. Well, what if you have 1,000, 2,000, 3,000 shares of a position that you're doing it on? That money hits your account right away. You're getting paid that premium right away. If that price does go higher than the strike, you get the gain in the stock plus the premium, right? So if you were to actually, and I'm going to modify this a little bit, if you were to buy it at 437 and it goes all the way up to 452, well, you still get to get that appreciation. So if it goes from 437 to 452, that is about a 3.5% move. So you're automatically making 3.5% in that trade right away. Plus, you get that 0.25% from the premium that you've made. So in 1 week, you might have just made 4%. But if someone else had done the trade, they would have only made, right, just that 3.5%. They wouldn't have made that extra 0.25% gain. So now you've outpaced everybody else just by that premium. And if they had made the same trade as you would have actually made out ahead. Now, I talked about you don't really prevent the underlying from moving and protecting that value. It's the same thing again with real estate. But here's the thing, is when you're selling and you're getting those premiums, that premium that comes in is reducing that drop, right? Because let's say the S&P 500 drops by a 1% that week. Well, you just made a 0.25%, right, on selling premium. So, in fact, you've actually done better than most of them. Anyone else who's not doing this strategy, you've done better than. They may be down 1%. You're down 0.75 now. Okay. Let's say it goes down again another percent the next week. Well, now you've got 0.5%. So now you're only down 1.5 where everyone else is down 2. And this is where it keeps going. And as people continue to hold their positions, if the market drops 3, 4, 5% over 2 or 3 months and you've been doing this premium strategy, you're keeping yourself higher than everybody else. And then when it comes back, well, now you have the appreciation from your stock. And as long as you're continuing to look at where you need to be for the week or quarter or year, you're not losing those shares. So you're getting the upside appreciation and you're getting the premium. So this is why I tell you this strategy can make money in any market. I've been doing this strategy for over 5 years in a combination of different other types of strategies. I love this strategy because it allows me to basically, again, shave. I'll use it as, sorry, my head went to another place. It allows me to basically trim the leaves off the money tree. I'm not taking branches. I'm taking leaves. And to be able to continue to do that, you can take the money, you can reinvest the money, or you can just let it continue to just compound and you just create a cash position. There's so many things you can do with this strategy. The key thing is you just got to know what to look for and how to do it, right? So I brought up here beginning, can I do it on anything and everything? Well, yes and no. So the key thing to know is with high volatility stocks, and those are all volatility means is it just ebbs and flows. So it goes up, down, up, down, up. It's got more movement. So your high technology stocks, your Teslas, your Amazons, your Googles, they tend to move a little bit more than say your Walmarts and your Lowe's and your Home Depots. And the more they move, you can actually make some good money. Like I was looking at Google this week, and on a weekly trade, and again, if you had 100 shares of Google, you could do this. Now, I know the cost. I mean, you're talking almost $300,000 for 100 shares of Google, but you could also make $900 this week if you had 100 shares of Google by buying one contract. I know people who have Apple this week, another one that you're able to make some good premium on as long as you're looking at where the price is going to be. And then there's some stocks out there, like ones that never move, your 3Ms, your Alcoas. They have quarterly stock options. So their premiums usually aren't that good. So sometimes it's not even worth looking at those because you're squeezing juice out of a dead lime. It doesn't make sense. So the S&P 500, things that have a lot of people buying into it, a lot of market participants, people buying and selling, that's called liquidity. It provides a lot more opportunity to be able to do this strategy. So I see how it works. How do I actually do this in my own accounts? Well, here's kind of the thought process I have. And when you look at it, what we want to do is you got to decide what type of account you're looking at. Okay. If you're using taxable money, this is going to be something that you probably want to do a sidebar with me. And maybe that's a question you ask at the end of this is, how does that impact my taxes? Because that's a little bit of a conversation, and it could probably take about 10, 15 minutes. So I don't want to hold ransom everybody here. The other thing is wherever you're doing your investing or let's say you're investing, you'd want to apply for options level 1. Now, for most part, beginners can get approval for options level 1 because there's collateral that's involved, whether you're doing covered calls, cash secured puts. There's some level of protection for the brokerage firm that even if you blow yourself up, they get paid, they get taken care of. But my aspect and my goal here is not to have you have that problem. That's why I want you to be a part of this series, to be able to understand what it is. And then you want to also determine what kind of income you want to generate. Okay. Do I want to make a little bit of money often, or do I want to make a lot of money and just wait and see by putting 2, 3, 6 months behind this? And then determine what positions you want to use. Like I said, you don't have to do it necessarily on the S&P 500. S&P 500 is a little bit less volatile, less movement because there's a lot of stocks and a lot of participants. But let's say you have Ford. Let's say you have Apple. Let's say you have Google. Let's say you have GE. There's many different lower dollar positions you can buy into. I mean, I think GE's, let's just say $20. So for, what is that? I think 2,000 times 20. Yeah. So for 100 shares of GE, you'd need $2,000. And then you can basically write one option against those 100 contracts. So you have a lot of things. There's a lot of things you can get into. So sounds like a good idea, but did I overwhelm you with all of this? It's new. It's exciting. Everybody wants to make money. I want you to make money. That is why I'm here. That is why I opened up my own firm. My own firm is it's to dedicate myself to helping you achieve what I've achieved. And I want you to get there. And I actually want to be a part of it to be able to help you get there. So here's the good news. There's 3 ways that I can help you. Okay. And I'm here for you. You can do it for yourself. Okay. You can basically sign up for my trading newsletter. It's a free resource. You just email me. I give you a couple of trades, especially when it comes to cover calls on a weekly basis. If you understand this strategy, but you're just looking for some plays, send me an email. I'll get you the detail. Okay. Let's say you've never even heard of covered calls until we went over this today. Great news is I can actually partner with you. And what I mean by that is if you don't know what you're doing, or you've never heard of this, or you want to learn how to do this, I can partner with you. I can help you set up the account. I can help you see the opportunities, but you place the trades. And there is an initial point where I want to run through a little bit more detail on how to actually pick out these trades, what you're looking at on charting, all these things. But I partner with you. We are in tandem. The way I like to think of it is I'm your caddy while you're playing 18 holes at Ponte Vedra. Okay. We're going to partner together, but I'm going to help you get everything you need to get up, get started, and get you running. And then the last one, where you like this idea, maybe you don't feel like you have the time, maybe you don't want to dedicate the time, but you think it's a great idea. I can do it for you. And I basically help you set up the account. I take over the trades for you, and we work together to help you get to your goals as quickly and safely as possible. Where I'm driving, you're basically in the back planning your vacation or how you're actually going to spend that money. So 3 ways I can help you. These are things that if you're interested in these, give me a call, give me an email, ask me questions, here at the end on how it actually works. But definitely let me know how I can actually help you take advantage of this strategy. Because if I haven't said it enough, this strategy is definitely something that will set you above and beyond other people. And the good news is regardless of any strategy or any one of these ways that you choose for me to help you, I make it extremely cost effective. So that way you are getting the benefit of this and that you're not losing it to the fees and costs that I've put out there. So these are the 3 ways that I can help. Here's a couple of ways that you can get a hold of me. You can go onto my website, Black Creek, www.blackcreekwealthmanagement or WM.com. So that's www.blackcreekwm.com. You can email me at blackcreekwm@gmail.com or give me a call at 904-240-2930. You get me directly and I'll be able to take it from there. But at the end of the day, I ran a little bit over that 30 minutes, but I hope this was informational. I hope you were able to gain some insight into this unique strategy. I hope I got you excited about it, but I'm here for you. So at any time, give me a call. I really appreciate it. Send me an email. God bless. I'm going to go ahead and set up where I can take some questions. And again, I'll put this out again tomorrow. If you need anything, let me know. God bless and have a great night.